Welcome to the Depth Dive. Today, we are really tearing into the fiscal 2025 Q3 earnings from Installed Building Products, or IBP. And this is, well, it's a fascinating story because IBP just delivered a quarter of record sales and profitability. They prove they can make money, expand margins, even when the broader residential housing market is actively working against them. The core narrative here really isn't about a market tailwind helping them out. This was like purely an operational win. They were driving their own machine through discipline and diversification, even as management themselves called the environment challenging.
Exactly. And I think for those following the building sector, the big question was how? How could a company with so much exposure to new residential construction possibly beat expectations, let alone expand margins when the volume side of things is soft? So we're going to focus on that answer, how IBP leveraged segments like heavy commercial to sort of decouple from that housing volatility, and also why their geographic mix is proven to be, well, a massive advantage.
And the market, well, it seemed to like the answer. The stock popped over 3% on the day. That signals a pretty clean beat, right? And it reinforces this idea that it's a resilient business model. Okay, so let's start with those high-level figures, the ones that drove that immediate reaction. Adjusted earnings per share came in at a remarkable $3.18. That smashed the Zacks consensus estimate, which was $2.69. I mean, you're looking at an 49 surprise. That's like an 18% beat on the bottom line. Pretty huge.
Yeah, and that performance wasn't just luck. Revenue was solid, too, hitting $778.2 million. That was roughly, 4 or 5% above consensus? But the real story, I think, is in the quality of those earnings. Adjusted EBITDA reached $139.9 million, and critically, that gave them an 18% margin. That beat expectations by about 70 basis points. So they're not just hitting targets. They are, optimizing every layer of cost management.
Right, and that focus on efficiency, you can really see it in their cash flow numbers. Operating cash flow for the quarter surged 22.4% year over year, hit $124.1 million. When a company pulls cash out of the system that efficiently, especially during a period of, slowing volume, it says a lot about their operational leverage.
It absolutely does. I mean, saying they're running tighter, that's almost too generic. What this cash flow surge really tells us is they have excellent control over working capital, specifically inventory and receivables. They aren't leaving cash tied up on job sites. That rapid conversion of revenue into cash, it's up 16% year to date over 2024. That's the hallmark of strong operational maturity, real leverage. They're collecting cash faster than they spend it, which is crucial when volume is, decelerating.
Okay, so let's unpack this top-line performance a bit, because this is where that diversification story really shines. Overall, same branch sales were roughly flat, which sounds kind of meh, right? Until you look under the hood.
Right. If you look at their core exposure, same branch installation sales for new single-family homes, they were actually down 2%. That's the residential headwind you'd sort of expect to see. They definitely lost volume there.
But, and this is the key, they found this powerhouse growth engine to offset it completely. Total commercial sales are up about 12% in the quarter. And that growth was specifically led by the heavy commercial segment. Same branch sales there increased over 30%. I mean, that kind of strength just completely overwhelms the residential softness. It's diversification in action, not just theory.
Yeah, that 30% figure is, it's remarkable. But it does raise an important question for you, the listener. Is that a permanent shift in demand, or maybe just a one-time catching up on backlogged projects? Management sounded confident in the ongoing strength of the commercial backlog, but that level of outperformance is tough to maintain forever.
It's absolutely the key driver, though, that allowed them to decouple from the choppy housing cycle this quarter. Okay, let's dig into the margins now. Because despite those flat overall same branch sales, their adjusted gross margin landed at a strong 34%. So how did they pull off that margin expansion when overall job volume was actually falling?
Well, management explained the key trade-offs in the installation segment. They lost the battle on volume, right? That was down 4.5%. However, they totally won the war on pricing power and, crucially, selecting better jobs. Price mix contributed positively, up 4.4%. So that basically meant their pricing power and better job selection nearly neutralized the entire decline in job count. It was almost a wash.
Okay, so if volume was basically negated by pricing and mix, where did the actual margin expansion come from?
It was overwhelmingly a favorable mix shift. We're talking geographic mix, customer mix, and product mix. The shift toward that heavy commercial segment, which generally operates with structurally better margins than entry-level residential work, That was the biggest factor. It contributed about 100 basis points of gross margin benefit alone. They consciously chose higher margin work over just chasing lower margin installation volume. Smart move.
And let's drill deeper into that geographic mix point you mentioned, because that seems like a structural advantage. Why does their overweight position in the Northeast and Midwest, the top half of the country as they put it, translate directly into better margins?
Yeah, this is really critical to understanding their sustained profitability. It's not just a quarterly thing. Markets in the North and Midwest, they typically have higher building codes, right?
Yeah.
Generally larger homes too, and importantly, basements. Lots of basements. So if you're insulating a full basement and just a larger structure overall, your material density, the complexity of the installation, and therefore your total contract value per job, it's just significantly higher. Compare that to, say, putting standard fiberglass into a single-story tract home wall down in the Sunbelt. That huge difference in the average ticket size allows them to sustain those high teens EBITDA margins. It really separates them from peers who have greater Sunbelt exposure.
Okay, so beyond the organic growth and mix management, the company is clearly sticking to its strategy of being a relentless consolidator. Year to date, they acquired businesses representing over $58 million in annualized revenue.
Absolutely. And the M&A strategy, it isn't about some massive transformative deal. It's disciplined. It's about tuck-in acquisitions focused on complementary products and deepening regional density. They mentioned examples like Carolina Precision Fibers and Echols Glass and Mirror, good fits. And this whole strategy M&A alongside that operational discipline, it's all supported by what looks like a bulletproof balance sheet.
Speaking of balance sheets, they returned nearly $213 million to shareholders year-to-date 2025. That's through dividends and share repurchases, really highlighting their capital allocation playbook. And with leverage sitting at a very comfortable 1.09x net debt to EBITDA, they've got significant dry powder for more acquisitions, pretty much regardless of what the housing cycle does. Right, so given the strong capital allocation buying companies return cash, the next logical question is, what environment are they actually operating in? Let's move to the outlook. Management painted a picture. They called it constructive but not euphoric.
Yeah, they were very candid about the macro constraints. CEO Jeff Edwards reiterated that homeownership remains, quote, incredibly expensive. He noted this reality is constraining entry-level demand, especially out in those high-priced Western regions. The company's currently benefiting, though, from its exposure to the more resilient custom and move-up segments. Those buyers are generally less price-sensitive.
Okay, but the forward guidance, it kind of throws some cold water on that massive Q3 beat, doesn't it? Management expects the public home builder segment volumes to face a high single-digit decline in Q4. That suggests they see those residential headwinds strengthening pretty significantly in the near term.
And here's the really crucial update, the one that truly changes the investment timeline for this stock, I think. The expected recovery in the multifamily sector, which the street's been really anticipating, has been pushed out significantly. Management now sees meaningful benefits delayed until late 2026.
Late 2026? Wow, that's a huge delay compared to earlier hopes of maybe seeing a recovery start in 2025. For investors playing the housing cycle, I mean, that fundamentally changes the whole time horizon for the next big growth inflection.
It absolutely does. And look, they issued an internal forecast for Q4 2025 EPS around $2.30 to $2.40. Which suggests they do anticipate the momentum from heavy commercial maybe moderating a bit as that residential segment decline kicks in more aggressively. So this cautious forecast, plus the delayed multifamily recovery, that's really what tempered the stock's gains after the initial, beat euphoria wore off.
Okay, let's talk about the valuation tension then, because this seems like the critical conflict for investors right now. IBP has significantly outperformed the S&P 500 and the homebuilders ETF, XHB, over the past year. Their stock-specific strength is undeniable.
Right, and the market reaction kind of reflects that tension. Investors love the margin beat, definitely. But they sobered up pretty quickly on the cautious housing outlook and that multifamily delay. The sell-side consensus, it remains cautiously neutral. Basically a reduce hold rating with an average price target around $224 to $226.
The stock's currently trading around $265. That's a massive disconnect from that target. Doesn't that high valuation, especially coupled with management's own forecast of a high single-digit volume decline in Q4, doesn't that suggest investors might be ignoring the near-term reality a bit?
Well, analysts aren't saying the company is bad. Not at all. They're saying the stock price might have gotten ahead of the housing cycle recovery. The current valuation, it seems to demand not just good execution, but like perfect execution for the next 2 years. And that's before the multifamily recovery, the major catalyst, even hits the numbers. Essentially, IBP is being priced more like a high-growth industrial stock right now, not necessarily a cyclical building products company tied to housing starts.
And just as a final kind of critical piece of evidence reinforcing that cautious view, the sources noted insider selling by a senior executive shortly after the earnings print. That kind of confirms that maybe people inside the company agree with the street that the current price is perhaps a little rich and already fully reflects the operational excellence they've shown.
Yeah, it adds to that cautious overlay. Nonetheless, the strategic story itself holds firm, right? IBP is a resilient operator. They're using strong free cash flow and low leverage to compound returns through M&A and capital return. They are definitely mitigating the cyclical risk better than most of their peers seem to be.
Okay, here's where we pause for just a moment. We need to remind you that this discussion is purely for informational purposes. We're just presenting the data and analysis from the earnings call. Nothing here constitutes personalized investment advice. Please do your own research.
But if we were, spitballing for a hypothetical committee, here's an outrageous but plausible trade idea based on the call's key takeaways. We'll call it the Hemi Hauler head. It's a nice ring to it. Okay, so the thesis is pretty simple. IBP is effectively decoupling from the near-term residential housing cycle. That's thanks to that heavy commercial strength and their disciplined M&A. However, the big multi-year growth catalyst, the multifamily recovery, it's confirmed. But it's far out, late 2026 now.
Okay, so we need a position that rewards them for their current operational excellence, but also lets us capitalize on that massive but deferred catalyst way down the road. How does that actually work in practice?
Right, so the trade would involve a multi-layered position. Think of it in parts. First, implement a near-term long. You could buy IBP shares or maybe some short-term in-the-money call options. This is betting on continued operational outperformance and margin resilience over, say, the next 6-9 months. You're basically betting that the continued 30% plus heavy commercial growth offsets that Q4 residential decline better than the market currently expects.
Okay, got it. And for that major catalyst that's like 2 years away now, the multifamily recovery, how do we play that long shot without tying up huge amounts of capital today?
Good question. Second part of the trade, to capitalize on that highly anticipated but deferred multifamily inflection. We purchase highly speculative, way out of the money call options expiring in January 2027. This minimizes your capital exposure right now, but it provides huge leveraged upside if that late 2026 recovery actually materializes and sends the stock soaring past current consensus targets, well into 2027.
Betting on a 2027 expiration, that sounds pretty volatile. What's the risk there if the recovery slips again, maybe into 2028?
Oh, it is highly volatile. Absolutely. Which is why you'd size this part of the position pretty small. You're essentially buying pure leverage on management's current forecast timeline. If the recovery does shift further out, the premium on those options is likely lost. But you've minimized the capital at risk while still keeping exposure to the ultimate cyclical turnaround whenever it happens. And then finally, there's the pairs component. You could look to fund the trade partially by shorting the XHB Homebuilders ETF. As you noted, IBP has historically outperformed the basket of homebuilders during this choppy cycle. So shorting XHB could provide a beneficial funding component, and it also acts as a hedge against broader housing market malaise, just in case things get worse before they get better.
Okay, interesting structure. So to bring it all back to the core lesson here, IBP's Q3 success really wasn't about some macro tailwind lifting all boats. It was about management's ability to execute a diversified strategy, driving that 30% plus growth in heavy commercial, gaining share in resilient markets, all while being, frankly, soberly honest about the tough residential reality that's still ahead.
Absolutely. Yeah. And the single most important timing element for you, the listener, to monitor now is that multifamily recovery, which management has now explicitly pushed out to late 2026. So does management's skepticism correctly forecast a slowdown that will eventually justify that lower $224 price target? Or does that caution maybe once again create an opportunity for this stock to beat expectations as we head into next year? That's attention.
And that's the key question for you to explore as you dive into your own research. Thank you for joining us for this deep dive. We'll see you next time.